How does the DVY ETF perform in different market conditions? The performance of the DVY ETF, or the iShares Select Dividend ETF, can vary depending on the specific market conditions. Here's a breakdown of how DVY might perform in different scenarios. Bull markets. Potential outperformance. In bull markets characterized by rising stock prices, DVY has the potential to outperform the broader market, especially if the underlying holdings experience strong price appreciation alongside continued dividend payouts. The combination of capital appreciation and regular income can be a significant benefit for investors. Limited alpha. However, it's important to remember that DVY is passively managed. It tracks an index, so it can't outperform the market by a significant margin, even in bull markets. Actively managed funds might have a higher chance of capturing alpha, excess return compared to the market, during strong market upswings. Bear markets. Downward price pressure. During bear markets with significant stock price declines, DVY is not immune to these downturns. The value of the ETF can decrease as the share prices of the underlying companies fall. However, historically, dividend-paying companies tend to be more established and may offer some relative stability compared to growth stocks during market downturns. Dividend income as a buffer. One potential benefit of DVY in bear markets is the continued stream of dividend income. These regular payouts can help offset some of the potential price decline in the ETF's share price, providing a buffer for income-seeking investors. Volatile markets. Increased risk. Volatile markets characterized by sharp price swings in both directions can be challenging for DVY. The underlying holdings might experience significant price fluctuations, leading to increased volatility in the ETF's price as well. Potential for short-term gains. While volatility can be risky, it can also present short-term trading opportunities. However, actively managing such trades within DVY might not be suitable for all investors, especially those with a longer-term investment horizon. How does the DVY ETF compare to other dividend-focused ETFs in terms of risk? Here's a breakdown of how the DVY ETF compares to other dividend-focused ETFs in terms of risk. Factors affecting risk. Several factors influence the risk profile of a dividend-focused ETF. Underlying index. The specific index the ETF tracks plays a significant role. DVY tracks an index composed of U.S. equities with a history of high dividend yields. This focus on high-yielding companies can introduce some additional risk compared to ETFs that prioritize companies with a longer track record of consistent dividend growth. Investment strategy. Dividend-focused ETFs can employ different strategies. Some prioritize high current yields, while others focus on companies with a history of steadily increasing dividends, dividend aristocrats. ETFs targeting high current yields might take on more risk by including companies with higher debt levels or facing operational challenges, just to maintain those high payouts. Diversification. The number of holdings within the ETF also impacts risk. ETFs with a broader range of dividend-paying companies generally offer lower risk compared to those concentrated in a smaller number of holdings. Comparing DVY to other ETFs. Here's how DVY stacks up against some popular dividend-focused ETFs in terms of risk. High-yield dividend ETFs. Compared to ETFs that prioritize high current yields, DVY might be considered less risky. While DVY focuses on high-yielding companies, it also considers the overall financial health of the holdings. High-yield ETFs, on the other hand, might include riskier companies to maximize current payouts. Dividend growth ETFs, ETFs that focus on companies with a history of steadily increasing dividends, dividend aristocrats, are generally considered lower risk compared to DVY. These companies tend to be more established and financially sound, with a lower likelihood of cutting their dividends. However, they might offer a slightly lower current yield compared to DVY. Broader market dividend ETFs, ETFs that invest in a wider range of dividend-paying companies across various sectors and market capitalizations, can offer lower risk compared to DVY. This broader diversification helps mitigate the impact of a decline in any single company or sector. However, such ETFs might also come with a lower overall dividend yield. What are the potential liquidity risks associated with the DVY ETF? The liquidity risks associated with the DVY ETF, or the iShares Select Dividend ETF, are generally considered relatively low. Here's a breakdown of why DVY is typically liquid and the potential situations where liquidity issues might arise. Understanding liquidity risk. Liquidity risk refers to the ease with which you can buy or sell an investment at a fair price. A highly liquid investment allows for quick entry and exit without significant price impact. In the context of ETFs, liquidity risk relates to the ability to easily buy and sell ETF shares on an exchange. Factors contributing to DVY's liquidity. Large and established ETF. DVY is a large and well-established ETF with significant assets under management. This translates to a high trading volume, making it generally easy to buy and sell shares throughout the trading day. Underlying holdings. DVY invests in a basket of U.S. equities, typically including large and mid-cap companies. These underlying holdings are usually liquid themselves, further contributing to the overall liquidity of the ETF. Exchange listing. DVY is listed on major stock exchanges, like the NYSE Arca. These exchanges have mechanisms in place to facilitate smooth trading and ensure sufficient market makers to provide bid-ask quotes. Potential scenarios for lower liquidity. Market volatility. During periods of extreme market volatility or crises, overall trading activity can decline. This could lead to slightly wider bid-ask spreads for DVY, meaning the difference between the price you're willing to pay to buy and the price someone is willing to sell might be larger. However, compared to smaller or less actively traded ETFs, DVY is generally less susceptible to significant liquidity issues even in volatile markets. Large order size. If you're looking to buy or sell a very large block of DVY shares at once, you might encounter some temporary liquidity challenges. This is because it might take time to find a counterparty willing to transact on such a large volume at your desired price. However, for most individual investors buying or selling typical amounts, liquidity shouldn't be a major concern with DVY. What is the weighting methodology used by the DVY ETF? The DVY ETF, or the iShares Select Dividend ETF, tracks a specific index, typically the Dow Jones U.S. Select Dividend Index. The weighting methodology used by this index determines how much of the DVY ETF's holdings are allocated to each underlying company. Here's a breakdown of the weighting methodology commonly used by such dividend-focused indexes. Focus on dividend yield. The index prioritizes companies with a history of paying out a significant portion of their profits as dividends to shareholders. This means companies with a higher dividend yield will generally have a larger weighting within the index. Free float adjusted market capitalization. The index might also consider the free float market capitalization of each company. Free float refers to the portion of a company's shares that are readily available for trading in the public markets. Companies with a larger free float market capitalization, essentially, the total market value of the publicly available shares, might have a higher weighting to ensure sufficient liquidity within the index. Additional refinements. Some indexes might incorporate additional factors like the company's dividend history, consistency and growth of dividend payouts, profitability metrics, and liquidity screens to further refine the weighting methodology. Understanding weighting methodology's impact on DVY. Exposure to high-yielding companies. The weighting methodology prioritizing dividend yield means DVY has a higher exposure to companies with a larger portion of their profits distributed as dividends. This can be attractive for income-seeking investors. Potential sector concentration. Companies within certain sectors, like utilities or financials, are known for their high dividend yields. The focus on dividend yield within the weighting methodology might lead to a higher allocation towards these sectors within DVY. Limited influence on underlying holdings. It's important to remember that DVY passively tracks the index. The weighting methodology is predetermined by the index provider, and the DVY fund manager has no control over the selection or weighting of individual holdings. How frequently are the holdings of the DVY ETF rebalanced? The holdings of the DVY ETF, or the iShares Select Dividend ETF, are typically rebalanced on a quarterly basis. This means the index provider, usually Dow Jones in this case, reviews the composition of the underlying index DVY tracks every quarter and makes adjustments to ensure the holdings accurately reflect the target weighting methodology. Here's a breakdown of the rebalancing process and its implications for DVY investors. Maintaining target weighting. The index uses a specific weighting methodology, often prioritizing high dividend yields and free float market capitalization, to determine the ideal allocation for each company within the index. Rebalancing ensures that these target weightings are maintained over time. Impact of market fluctuations. As stock prices fluctuate throughout the quarter, the weightings of individual companies within the index can deviate from the target levels. Rebalancing addresses these deviations by buying or selling shares of certain companies to bring their weightings back in line with the target methodology. Potential for transactions. During rebalancing, the index provider might buy additional shares of companies whose weightings have fallen below the target level. Conversely, they might sell shares of companies whose weightings have exceeded the target. These transactions can lead to increased trading activity within the ETF. Tax implications. For some investors, when DVY sells holdings during rebalancing, it might trigger capital gains distributions for shareholders. These distributions can be taxable events, depending on how you hold the ETF, e.g., taxable account versus tax-advantaged retirement account. What are some alternative dividend-focused ETFs to the DVY ETF? The DVY ETF, iShares Select Dividend ETF, is a popular choice for income-seeking investors, but there are several alternative dividend-focused ETFs available, each with its own unique characteristics and risk profile. Here's a breakdown of some popular alternatives to consider. Considering your investment goals. Before diving into specific ETFs, it's crucial to define your investment goals and risk tolerance. Here are some key factors to consider. Desired level of income. How much current income are you looking to generate through dividends? Risk tolerance. Are you comfortable with potentially higher risk associated with high-yielding companies, or do you prefer a more conservative approach? Investment horizon. Are you investing for the short term or the long term? Diversification preferences. Do you prioritize broad market diversification or a more concentrated focus on high-yielding sectors? Alternative dividend ETFs. Here are some alternative dividend-focused ETFs with varying characteristics to consider based on your goals. Higher current yield, potentially higher risk. SPDR SP High Yield Dividend ETF, SPYD. This ETF offers exposure to a broader range of high-yielding companies compared to DVY. While it might provide a higher current yield, it also comes with potentially higher risk due to the inclusion of companies with lower credit ratings. Global X Super Dividend ETF, SDIV. This ETF focuses on high-yielding companies globally, offering diversification beyond the U.S. market. However, international exposure introduces additional currency risk. Dividend growth, potentially lower current yield, but focus on sustainability. Vanguard Dividend Appreciation ETF, VIG. This ETF focuses on companies with a history of steadily increasing their dividend payouts. While the current yield might be lower than DVY, it prioritizes the sustainability of future dividend growth. SPDR SP Dividend Aristocrats ETF, NOBL. This ETF specifically targets companies that have increased their dividends for at least 25 consecutive years. This focus on established companies with a strong track record can offer lower risk compared to DVY. Broader market diversification, lower current yield, but potentially lower risk. Vanguard Total Stock Market ETF, VTI. This ETF offers exposure to the entire U.S. stock market, including many dividend-paying companies. While the current yield will be lower than DVY, it provides significant diversification across various sectors and company sizes. Schwab U.S. Dividend Equity ETF, SCHD. This ETF offers exposure to a broad range of dividend-paying U.S. companies with a focus on quality and value. While the current yield might be slightly lower than DVY, it emphasizes companies with strong fundamentals. Alright everyone, that's all the time we have for DVY today. So, the verdict? DVY can be a solid option for income-focused investors, especially those with a long-term horizon. It offers exposure to established companies with a history of paying dividends, and the lower costs of a passively managed ETF are a plus. But remember, DVY does have limitations. The focus on high-yielding companies can lead to sector concentration, potentially amplifying risk in those sectors. There are also alternative dividend ETFs and actively managed funds to consider, depending on your specific goals and risk tolerance. No matter which path you choose, do your research and make sure it aligns with your investment strategy. For more in-depth discussions about dividend investing and ETF options, hit that subscribe button and smash the notification bell. We'll be diving deeper into specific alternatives and helping you navigate the world of dividend investing. Thanks for joining the chat on DVY. We'll see you on the next one.